Okay, hopefully you can hear us now. So good afternoon and welcome to our webinar on the ever-changing buy-to-let market. Before we get started, I'd like to hand you over to David. I just wanted to run through a few housekeeping points with you all to ensure the webinar runs as smoothly as possible. The presentation will run for roughly 30 minutes, with 10 minutes at the end for you to put questions towards David. We also have a few of our brokers sitting in on the webinar today, so if you would like to ask any questions throughout the presentation, please feel free to do so. We've had a great response to this webinar, so to ensure that we don't all talk over one another, we would ask that you all submit any questions by typing them in. To submit a question, as some of you have done already, you just need to click on the speech bubble in the left-hand corner where you should be able to type. Hopefully we don't encounter any technical problems, but if you do lose connection, don't panic. We'll be sending out a full write-up of the presentation, including the slides, to all attendees tomorrow. So we'll just hold on for a minute or so to see if there's any others joining, and then I'll hand you over to David. If you have any questions about the setup, if you want to put those through now. Okay, so yeah, a couple of minutes and then we will get started with the presentation. Hi Vanessa, no, Becky isn't with us today, but I can get her to give you a call Friday. Oh, that's good to hear. I think broker-wise today, we've got Paul Martins, Gary McKenna and Chris Longhurst in the room. Yeah, so I think we'll get started and people can join us along the way. So I'll hand you over to David.
Good afternoon, ladies and gentlemen, and I would hope I can probably get us done inside 30 minutes that Amy has kindly suggested. So the title of this presentation is the ever-changing buy-to-let landscape, and clearly there's been much talk in the market about the emergence of buy-to-let limited company lending. And of course this has been driven by two events. It's almost surreal to think we're 21 months away from when George Osborne stood up and served it up to landlords big style with a fundamental change in how you will be limited in your tax or your interest offset and the impacts on your taxes. And clearly that all starts with effect from tomorrow into this new tax year. So by the time you get to 2021, you are restricted to basic rate tax relief on your entire interest costs on your loans and buy-to-let mortgages. You might not have known that once he put that in hand, he then turned around to the Prudential Regulation Authority, which governs the lender's activities in buy-to-let, and said, and I want you to change your rules too. And this lands in two stages. The first stage landed on the 1st of January, whereby he made us all change our stress tests to reflect the tax changes you guys are going through, which restricts the amount of borrowings you potentially can achieve on personal borrowings on buy-to-let. But quite bizarrely, and rightly so, in a limited company, that doesn't change at all. And I'll come to the second stage that lands on the 1st of October, which is significant in our world and sadly is also significant in your world too. All of this leads to a massive change in how landlords look at how they own buy-to-let properties, especially if they're purchasing them from 2016 and going forward. And we've been out about talking to brokers and landlords to see how is this all landing. And when we talk to brokers or landlords, we say, so we can mix buying a buy-to-let property. and you're financing it, how have you actually gone about buying it? Have you put it into a limited company? Is it as much as 1 in 10, 1 in 4, or a half, excuse me, or more than a half? And clearly when you see the results on this next page, you'll rapidly realise that I was ambitious in my percentages, because the great proportion is that we're seeing less than 1 in 10 transactions being bought in limited companies, and that's where about sort of 80% of the data sits. And you'll see that these are mortgage events. If you look at the bottom, Financial Services Expo in London last year, MBE London last year, and the Specialist Lending event, which went around the UK, Harrogate, Chester, Birmingham, and London in January of this year. So there are a few doing as many as 1 in 4, perhaps 10%, 12%, but very few doing more than half. And if you look at the very top there was a major gathering of the heads of all the buy-to-let distribution companies, the major networks, last September. And you can see that even the people who are meant to be running these companies were a little bit at 6s and 7s as to what was going on. And that might surprise or indeed alarm you, but the education is as much ongoing in my marketplace as it is indeed in yours of landlords. So if we leave out the top group for the moment, the next 3 groups, the HMO Landlord Forum in Manchester, held over in TV City in Manchester, buy-to-let landlords in High Wycombe, and the Premier Property Club in Knightsbridge, which was just a gathering point. It didn't mean they were all Knightsbridge landlords. You could see that in those groups, the level of engagement where 1 or more buy-to-let properties had been purchased in a limited company was better than a quarter, and indeed in some instances above 1/3. And that's probably rightfully what you would recognise, where landlords have some degree of interface with fellow landlords and they have discussions, and at those sorts of gatherings you get professional advisors such as accountants, tax advisors, lawyers, and indeed mortgage brokers. And in fact, of those 3 groups, 2 of them were actually run by mortgage brokers who are making sure they put the message out there. I felt a lot of empathy for the first group at the Property Investor Show in October in London Docklands, and I walked into the room with 90 landlords who had just heard from Steve Bolton that the High Court claim to set aside Section 24, i.e. these tax changes, had just failed. And therefore it probably wouldn't surprise you that not a single one of those landlords held a property in a limited company, and they really were hoping that Mr. Bolton was going to deliver some good news. I know that battle goes on, and I wish those involved every success, but I think if one thinks about business as a whole, looking in the rearview mirror is rarely helpful. One has to deal with what's visible and move forward as best you can. So we will wait to see what happens further in that, but we've now had Mr. Hammond in place for 2 budgets, and he's made no indication that he's going to change anything anytime soon. So there's been a lot of talk about whether lenders have stepped up to the plate, and are lenders offering enough capacity for landlords to be able to borrow money. And certainly if you go back to 2014, there was only half a dozen lenders active in the market, probably offering sort of 80 or so products. But then you could say, well, not many landlords were buying in limited companies, so there wasn't a lot of requirement. But track that through to today, where we've got 15 active lenders who both do personal and limited company, out of the total pool of 37. And of those 1,167 products, 266 products are specifically for limited company borrowers. So that's better than 23, 24% of the market capacity. The second challenge to landlords from their tax advisors and accountants are, well, of course, it's going to be a commercial mortgage and you're going to pay higher rates than you would if you were borrowing personally. Of those 15 lenders, almost without exception, if you go in through their front door, either personally or as a limited company, they will offer you the same price and the same fees and the same overall arrangements. It should make no difference as to how the lender treats you. I would agree that that was not the case even a year ago, but now you will find lenders will treat you the same. Now that's not to say there isn't a lender out there who's not lending on limited companies that isn't cheaper than any of the 15 that are offering limited company loans, and I can't do anything about that. But those lenders that are offering in both camps have generally stepped up to the plate. And if we say that the market is less than 10% of mortgages are done in limited companies, the fact that there's a 20% availability or more than 20% availability of product says that lenders are open for business and will welcome applications from limited company borrowers with open arms. So, limited company lending. Who are the movers and shakers in this market? And hopefully there'll be 15 names up there, as indeed there were 15 names or 15 numbered on the page before. And of course, those of you who've been involved in commercial business will know that lending to a limited company isn't quite so simple as lending personally. So when we look at the lenders as mortgages for business, we look towards lenders that start off by treating it almost as if it was a personal loan. So they've got a first charge on the property, but they look through the company and they take unsecured personal guarantees from the directors for the loan amounts. And you can see 5 names up there: Foundation, Kent Reliance, Axis, our own brand Keystone, and Precise. The next group down, as well as taking a first charge on PGs, take a floating charge over the assets of the lending vehicle. And that doesn't have to be a problem in the early days. But when you start refinancing assets within a limited company where another lender has a floating charge, you have to get their permission to do so. They cannot unreasonably withhold it, and they have to provide a letter of non-crystallization. Now, a letter of non-crystallization almost sounds interesting, but trust me, in the world of dull, this gets 10 out of 10, and is very low priority in the world of the administration department of any lender, if indeed any priority whatsoever. So you can occasionally find yourselves hung up at the back end of an administration system where your new lender won't issue with an offer because you haven't got a letter of non-crystallization from the other lender who's taken a floating charge over the company's assets. And the group at the bottom that go to the next stage and take the venture is because they're used to lending to trading businesses. And the fact that we're doing a buy-to-let property, or they're offering buy-to-let products, shouldn't be overlooked. But the fact is they're accustomed to taking debentures. And of course, a debenture does give that lender more power over your company than either of the 2 previous categories. But heck, the Metro Bank product could be the cheapest one in the market and the one that you particularly like or your broker's talking to you about. But do understand the significance of a debenture, and it's part of your decision process as to whether you'd find that acceptable. But here's the bit of irony. You can see in that bottom group Interbay, and you can see in the top group Kent Reliance, both owned by one savings bank, one of our very successful challenger banks. An astute broker will probably be able to negotiate with Interbay to have the debenture set to one side, because if after all your property company does is own property, there's no purpose of having a debenture because it doesn't get you anything better than the first charge you already have. But it's important you understand that things can be a little bit more complicated. There is much talked about on the subject of incorporation and stamp duty land tax relief when people choose to take the existing assets that they own and sell them into a limited company. We are very specific in our offices, I hope, and indeed anything we say or write, in calling it a sale. Some people will call it a transfer. It is not a transfer, it is the sale from Mr. and Mrs. Jones personally to Jones Properties Limited. And this possibly and probably leads to tax consequences. Now, we're not tax advisors, nor is any broker with whom you choose to communicate. So we will, and I'm sure most brokers will, encourage you to go and speak to an accountant or a specialist tax advisor, depending on the complexity of your affairs, to make sure that you get the right tax advice. But in essence, as I understand it, if you're running a business, i.e. it's where you spend your working day, you're not in a big paid day job elsewhere, and this is the sole source of income for you, you probably qualify for Section 162 incorporation relief, where you can say, I'm running a trading property business, I now want to incorporate, and you can avoid for the time being the payment of capital gains tax, and the tax that would otherwise have been paid is rolled up and recognised in the structure of your new company. I refer then to the Ramsey decision, which was Mrs. Ramsey versus HMRC in the High Court in Liverpool in May 2013, where she was, much to the chagrin of the HMRC, able to prove that she ran a flipping business, and in actual fact she cleaned the floors of her own HMO, and therefore it was her business and incorporation was permitted. The really difficult bit, I am told, is getting stamp duty land tax relief, and the only legitimate way to do that is you need specific exemption to do it, and you have to go from a partnership into a limited company. And our strongest advice is you need that exemption up front, and you speak to the stamp duty land tax office and you tell them exactly what steps you're going through, and they'll give you a letter that says we're minded to approve. They certainly don't give you a carte blanche, and then your lawyers have to submit the stamp duty land tax forms the normal way. And I emphasise again at the bottom of this page, brokers do not advise on tax advice or accounting matters, and landlords should always seek professional property tax advice. Here's my gut reaction. If you own a number of properties, and let's say they might value 3, 4, 5 million, which is not untypical of landlords that we speak to, is that you'll look for a strong local firm of accountants to you with somewhere between 10 and 20 partners, and you look at their mugshots on their website and you see that 2 of them at least specialise in property and property taxation, and you write them a brief and you jolly well go and see them. This is important stuff, ladies and gentlemen, and you really want to make sure you get it right, because it's very difficult unwinding these things at the back end. Pros and cons of a limited company, the perceived wisdom, and certainly we're now seeing 77% of our purchase applications being carried out in a limited company, is that clearly corporation tax rather than income tax, and corporation tax is on its way down, and by the time we get to April 2020, or the 6th of April that year, corporation tax is currently expected or has been announced to be at 17%. Of course, your interest relief remains a fully allowable expense within the limited company business. And those stress tests that landed on the 1st of January for personal borrowers have remained unchanged in limited companies, which possibly means that in many instances, you'll be able to borrow more loan against the same asset with the same rent than you'll be able to do personally. And of course, there's now lots more product choice than there was before. Here I'm showing only 195 products, but we updated our main index only the other day to 266. So schoolboy error for me there. But there's now plenty of choice there from which you can choose with your broker. And indeed, I'll emphasize the point again that we would expect in many instances that the same price would be offered to you by the lender if you walked in for either a personal or a limited company loan. What I can't talk specifically about is how you extract the money out of a limited company, because much will depend on how you set up the limited company and the tax advice you had on the way in. But it is highly likely with CGT on a personal disposal at 28% for higher rate taxpayer that you wouldn't be able to extract money from the limited company quite as efficiently by the time you pay corporation tax and you've taken dividends out and paid tax on that. But there again, it is very specific as to how your company was set up and what you've got in there in terms of loan accounts and how you're able to do something with the company. So how is this all going to pan out in the world of lending? And I appreciate these are high-level numbers, but by my giving you some high-level numbers, we're trying to give you a view of what's going on in the market. So in 2015, when George Osborne stood up and was very unpleasant to all of you landlords and really tried to make you the villains of the whole market, the first-time buyers couldn't buy because you were snapping up all the properties in the market, when in actual fact it was down to 2 things, the planning system that doesn't work in this country and the unwillingness of the major house builders to build more housing units because they like to control supply. You guys collectively on both remortgages and purchases borrowed 37.5 billion. It's probably no surprise that last year it went up to 40 billion because there was a stamp duty deadline of the 31st of March and a lot of transactional activity, especially purchases, went through ahead of that deadline. But here's the interesting figure, that within last year's numbers, that there hides a certain reluctance from some investors and landlords to transact on new properties, because the normal 45% purchase and 55% refinance sunk down to 28% purchase and 72% refinance. So looking into this year, we're expecting the market to contract slightly, driven by two things essentially. Firstly, if landlords continue to own the majority of their properties in their own name, which clearly is the case because they can't readily change how they own historic properties, they will find that they are pound for pound borrowing slightly less on the same property than they would have been prior to the end of December. And secondly, if landlords aren't buying quite as much, so wait and see how all this pans out, the purchase activity this year could remain slightly subdued. You'll wonder then why my figure for 2018 steps down significantly further from 38 billion this year to 33 billion next year. And this is the second phase of the Prudential Regulation Authority landing in our world, saying that from 1st of October, they require all lenders, and it's not just a few, but all lenders, to show much more curiosity about landlords' background income. There is a joke in the mortgage market that some lenders have never shown any curiosity, and all you had to do was sign an application form to get a buy-to-let mortgage. And that clearly was perhaps the case ahead of the credit crunch, but since the credit crunch, lenders have been using electronic systems to help them make lending decisions. Now the regulator is saying, that's not good enough. We want you to look a little bit more into the affairs of your landlord and see how your landlords service not just this mortgage, but the other mortgages in the background. And their definition of a portfolio landlord, right or wrong, and it's an arbitrary number, is where a landlord owns 4 or more mortgaged properties, either in his or her own name, with a friend, a partner, a wife, a husband, or indeed in a limited company where they have a beneficial interest. Now, whether some of the lenders will get to all that minutiae of detail is a debatable point, but the reality is that from 1st of October, for those of you who used to do mortgages in the late 1990s and then the early 2000s, where you felt like you had to empty your entire filing cabinet into a photocopier, there could be a slight feeling of that with some lenders as they interpret these rules beyond 1st of October. Our concern is that in amongst the 37 lenders that we track, there is a significant majority who have never been accustomed to asking these questions, but will be required by the regulator to do so from, from the autumn. And even when you and I put together the information and sent it into them, they won't know quite what to do with it. And although they would have been well trained up by their senior managers on how to process paper, if the paper doesn't look like that which they saw on their training course, there'll be lots of toing and froing. Excuse me. And this is why we think the market in 2018 may contract slightly. That's not to say it won't be very competitive and lenders won't be out there with very, very good products, but we can see a little bit of a logjam coming up. And if you think that some of the processing times that you bravely endure when you're dealing with us and the lenders are tortuous, it might get a little bit tougher as we go through the winter months of this year, as we settle down to a new regulatory regime. We've overlaid the same graph, in case you think that it's exactly the same graph. We've overlaid the same graph of where we think limited company lending is going to be. So if we look at this year, we're saying sort of 3.5 billion out of 38 billion, it's about 9%. But next year, we're saying about 6 billion out of 33 billion, so that's sort of 18 to 19%. So it's more than double. And we're only saying these as projections because here's the thing that will surprise, confuse, and perhaps even frustrate you as much as it frustrates me. Here we are 20 months on, or 21 months on, from when George Osborne announced all these changes, and the market recognised within days that this would drive activity towards limited companies, but the regulator, in whatever guise, has not yet seen fit to collect data from lenders to know what percentage of your business is now being done in a limited company. The starting gun for this is the 1st of July this year, i.e. Q3. So they get data sometime in the autumn, and perhaps by Christmas we'll know how the market sits. So this at this stage is our best estimate based on the conversations we've had with the major specialist buy-to-let lenders who do limited company, Paragon, Kent Reliance, Precise, Fleet, all those names I mentioned earlier, and indeed the experience within our own brand of Keystone, where we are running on new applications, as I said earlier, at 77% of purchase applications now being in a limited company. And I'm really sorry we can't be more accurate than that, and it's regrettable that our side of the fence, or the lending industry, the broker industry, hasn't been able to provide you with better data on which you can see how other landlords are making their decisions. We can't roll back the clock, but hopefully we can get better at providing you with information in the weeks and months ahead. So this is the second point of what's in store for landlords coming up, and this is the wonderful document that the Prudential Regulation Authority produced. In fact, they produced two, which is what civil servants do really rather well. And they set out here what they're looking for lenders to do. They want to see proper details of the portfolios and the existing mortgages. And they'll go away and they'll validate some of that stuff, either online, offline, or actually referring it to their own valuers. And they'll want to know where you are in things, in terms of things like your own house mortgage and house value, and how you are with your tax returns. And the one you will love or hate, depending on your sense of irony, is historical and future expected cash flow associated with all the borrower's properties. Now, I'm obviously a very simple-minded person. A property in a normal state of affairs has 2 events in a month. Hopefully the tenant pays you some rent, and hopefully very kindly you pay your lender if you've got a mortgage on it. Just how difficult does it have to be? But there it is in black and white from the regulator to lenders. And we're currently sitting down with lenders talking about how we can take raw data that you give us and we can throw it into a spreadsheet that frankly will frustrate us all and have no meaningful outcome. For those of you who are involved in businesses as well as your property businesses, in any other form of trading business, whoever has seen a cash flow forecast where the closing balance at the end of 12 months isn't significantly and materially better than an opening balance in month 1. But these are the sorts of hoops that we're going to have to go through, and we're going to try and minimise that which lands in your world. But as you can see, the world is changing, and we're waiting from all the lenders for their formal pronouncements of how this is all going to pan out. So just to really sum it up, how this impacts you guys in 2017 as landlords and investors. So those new stress tests have landed. The old stress tests that you would have recognised or your brokers would have talked to you about still apply into a limited company. But most of us have moved to 140 or 145% at the revert rate, unless of course you use a 5-year fixed rate, which is probably lower than 5.5% today, and the regulator will allow you to stress against a 5-year product, provided of course you agree with your lender you're going to borrow on that 5-year product. 7 of the lenders out of those 37 have some form of bespoke calculations that we have to run into offline, and of course they all ask for different bits of information. So the value of those bespoke calculators is perhaps a bit limited, but clearly we dip into them from time to time when we think it makes good sense. If you're talking with your broker, he or she or they should always offer you both a personal and a limited company quote on purchases, so that you can see and make informed decisions when you're talking to your tax advisors. So just going back to this part 2 of the PRA announcements from the 1st of October, do understand how it will affect you, and sadly do be prepared for more paperwork. The old SA 302 printout that shows very little other than the outputs of your income, or indeed if you have carried forward losses, no income whatsoever, probably won't cut it with most lenders. They may ask to see your actual underlying tax returns. And indeed, some of you may need to think about whether those underlying tax returns accurately reflect the up-to-date data in your portfolio, so that none of us end up having slightly embarrassing conversations. If I was a landlord sitting on some refinancing ideas for this year, but wasn't quite entirely sure when to do it, my gut reaction is do it before the 1st of October. Doesn't mean you have to draw down the money before the 1st of October, but certainly get your application going in the summer months and draw on the money later in the year, or perhaps indeed at the very end of the year. Not only because you're going to have to provide more paperwork to get access to the self-same products, but do you really want to be the guinea pig through some lenders who've never approached this sort of paperwork ever before? I'd always go for the easy option and talk to my broker early and try and get these matters moving. Sadly, the tolerance of the HMRC for people's tax affairs not quite coming up to the required level is declining. And they are actively going out and looking at people where they've discovered things that don't make them very happy. And this was in the mortgage industry press only 10 days ago. We can point you to a link afterwards if you'd like to kind of have a look at it. And the main article actually gives the name of the borrower, or the name of the particular landlord. And I'm not going to put it up here because that's a bit unfair, but you can bet your bottom dollar the first thing we did was feed that name into our own computer-based databases to see if we'd lent to this gentleman. He clearly chose to take HMRC on because he didn't even bother to submit any tax returns whatsoever. But the reality was, by the time they'd finished their earnest conversations with him, he ended up paying $281,000 of back tax. They fined him $200,000 on top, and they can fine up to 100% of the unpaid tax. He was sentenced to 2 years in jail, but suspended for 2 years, and he was given a couple of hundred hours of community service and a 6-month curfew between 8 PM and 5 AM. So clearly the revenue will go after people who spit straight in their eye. For anyone who has any concerns about the HMRC, they have, since the 21st of September 2016, declared a tax amnesty in perpetuity for landlords, allowing any landlord to go back and adjust any previous year's tax returns with no other consequence than any tax that is therefore due to be paid, but no fines, no community service, no suspended jail sentences. The view of the HMRC is they'd rather that people got it right, and if people are feeling nervous, that they go to HMRC and get it right, and HMRC will help them get it done, but woe betide you if the call is outward bound to HMRC, to you, saying, we don't think your tax affairs are proper. This does raise a question in our world that for both lenders and brokers, we are governed by the Money Laundering Act. And if we do find significant discrepancies in data provided from landlords from what they actually own and what they're declaring for the revenue, we have no choice other than to report it. Now, there are ways of dealing with it early on, where we can stop an application. Bear in mind, this is probably only going to apply to those of you who have to show tax returns from the 1st of October. Excuse me. And lenders will probably say, do you know what? I think I agree with you. Your customer might want to go and talk to HMRC and do something about his 2014-15 or 2015-2016 tax return. I don't want to finish on a note of it being the Grim Reaper, but it is important that you understand that HMRC are out there, and if it's any consolation, they are taking action in my world against advisors who give improper advice and step over the line and give bad tax advice. And indeed, in the larger distribution world of mortgage brokers and what we call mortgage networks, they are holding the directors of those organisations responsible from this year for anything that goes on their watch, even if they, as the boardroom of that distribution company, didn't know about it. Now, clearly I've talked for far too long, and hopefully we've given you a little bit of an overview of what we think that's going on in this world. If anyone would like to put any questions up now that they think would either interest them or benefit the other participants online, very happy to take them, or indeed you can come in on our telephone lines on 0345 345 6788 at a time of your choosing. Thank you very much, ladies and gentlemen. So Vanessa has put up a question that there may be exemption from stamp duty in some cases, and could I perhaps give an example? So, okay, Vanessa, let me immediately say I'm not a tax advisor, but what we gather is if someone is operating as a partnership and they're going to incorporate, they can incorporate, and indeed the incorporation event is what I call tax after the event, in the sense that you can do it with your accountants or tax advisor advice. You don't have to have HMRC approval to it, although some people do choose to get so. But the stamp duty land tax is you have to say, you write to the stamp duty land tax office and you say, we are incorporating this business, we're advised that this is feasible for us and we qualify to do it. We would also like, as a partnership, to ask for your approval or seek your outline approval that stamp duty land tax is not payable in this circumstance. And we've seen a couple of letters here, we've seen a few clients do it, whereby you put your exactly the same case as you put for the incorporation relief. You send them a full brief, probably including your tax advisor's letters of how you're going to go about it, and you go to the stamp duty land tax office and they repeat back the data to you, and all they say is, we are minded to approve. They never give you an absolute carte blanche, and then you go through the transactions, your lawyers file in accordance with the plan that you've agreed with your tax advisors, and they then have the right to agree it or not. It is unlikely, having had all the information up front and having said they are minded to approve, it would be difficult for them to step back from that, unless, of course, you've significantly changed the structure of the transaction between seeking that outline approval. But this is where the importance of having good tax advice comes in. And, you know, if you've got some significant assets in the background, this is why it is worth paying the tax advisors the fees that they ask. We do have a fact sheet on this subject where we suggest what we think goes on, Vanessa. And if you'd like to either speak to one of the guys, or in fact, you know Becky's email address, drop Becky a note, or we'll dig it out of our systems and we'll drop you the FAQ sheet as an attachment back to you.
Okay, so if we don't have any more questions, I think we're going to end it there. We will get a copy of this sent out to all of you, so thank you for joining us today, and we'll speak with you soon.
Thanks very much, everyone.